Hello, friends! Every trader in the market searches for only one thing: profit. But the market gives him the same thing every time: a trap. You might have noticed, every time you confidently take an entry, the candle reverses from exactly there. Stop loss hit. Then the market flies in the same direction, and you think, why does this happen only to me? And this is the place where the real game begins, of liquidity. Liquidity is the energy hidden behind every move. The market doesn't move up and down, it hunts. Your stop loss is its energy. Your panic is its profit. Your impatience is its entry point. And if you understand where liquidity is hidden, then the chart will no longer be a trap for you. It will become a roadmap. Smart money never looks at candles. It looks at the psychology of traders. It knows where the crowd places stop losses, where the crowd chases breakouts, and where retail traders get stuck in hope. And when the crowd gets trapped, smart money takes an entry. Liquidity is not where the price is drawn, it's where the crowd is sacrificed. Now the question is not where the market will go. The question is, where does the market need energy from? Because the price will go where there is energy, and energy is where liquidity is. If you learn to read liquidity, you won't search for entries, you will feel the movement. And on that day, you will transform from a retail trader to a smart money thinker. So get ready, because now we are about to step into a world where the secret behind every candle is about to be revealed. So friends, have you ever wondered why your stop loss gets hit every time? Why does the candle move against you every time? Why every time you think it will go up now, the market runs down, and when you sell, it becomes a rocket? Is the market against you? Is someone watching your screen? Or is there a hidden pattern that you haven't understood yet? Yes, there is, and its name is liquidity. Liquidity is a word that sounds very technical, but in reality, it's the blood flowing in the veins of the market. Liquidity is the energy that moves every candle. The market doesn't move in a vacuum. There is fuel behind every move. That fuel comes from traders' emotions, from their stop losses, their pending orders, their panic decisions. Every time a trader buys, he becomes part of the liquidity. Every time a trader sells, he also provides liquidity. The market hunts that liquidity. You think the market is random, unpredictable, but in reality, the market is 100% predictable, if you look at it from the right angle. Look, the market never moves without a reason. Every up move, every fall is due to someone's entry and someone's stop loss. And this is the game of liquidity. For the market to move, it needs both buyers and sellers. If buyers run out, the market will go down. If sellers run out, the market will go up. The market goes to where there is still liquidity left, where traders' orders are still pending. Now think, you bought near a resistance because you saw that last time the candle went up from there. Thousands of traders like you also bought, and everyone placed their stop loss right below that resistance. Now guess where smart money will go, up or down? Down, because your stop loss is down there, and that's where the liquidity is. The market first gives you the illusion that it's moving in your favor. The candle goes up, you get happy. Then it suddenly falls, and your stop loss gets hit. And after that, it again moves in the same direction you thought it would. Now you think, why did this happen only to me? But the truth is, you're not alone, you're part of the crowd. Smart money always goes against the crowd because the crowd is liquidity. Liquidity, in simple words, where the crowd is trapped, that's where the market's next move is. And where does the crowd get trapped? Where emotions are strongest, like breakouts, fake news, sudden spikes, or at the extreme ends of the chart. One thing always remember, the market is a hunter and liquidity is its prey. But it won't kill you until you run away in fear. It catches you only when you become predictable. Every time you think, now the breakout is confirmed, then the market thinks, now liquidity is ready, and it blows away your stop loss along with your confidence. Smart money doesn't catch candles, it catches crowd behavior. It knows where more people are buying, where more people are selling in panic. It goes where orders are filled because that's its food, liquidity. The market is a predator. It doesn't fight you, it waits for your fear. The biggest secret of liquidity is this: the market first takes stop losses, then gives direction. Retail traders think before entry. Smart money thinks before stop loss. Retail traders enter after the candle. Smart money has already built positions before the candle. And this difference comes from understanding liquidity. Now imagine one thing. You bought at support and the candle went down a little from there. Your stop loss was hit. You closed the position and then the candle reversed and went up. You get angry. Why did the market reverse after touching my stop loss? And you feel like the market is watching you. But the truth is, the market is not watching you. The market is sniffing for liquidity. Your stop loss was part of that liquidity pool that smart money wanted to collect. It went there, took liquidity, and then started the real move. Liquidity is where the market gets fuel. You see the candle, it sees the stop loss. You see a breakout, it sees trapped traders. You see a pattern, it sees liquidity pockets. That's why smart money is always one step ahead, because it sees the emotion behind the market. Understanding liquidity in trading means understanding market psychology. You need to see where the crowd is excited, where it's fearful, where it's in revenge mode. Because excitement and fear both attract liquidity. The market always punishes traders who rush in, because impatience is liquidity and the market needs fuel. The first secret to identifying liquidity is, where more people are confident, that's the dangerous place. The market's logic is always opposite. Where the crowd is happy, smart money is selling. Where the crowd is fearful, smart money is buying. Because smart money is emotionless, it only goes after liquidity. Now the question is not what liquidity is. The question is how to identify it. Where is it? Where are the retail traders? And how does smart money capture that liquidity and turn the market in its direction? Behind every high and low of the market, there is a story. That story is of liquidity. At every high, the crowd buys in FOMO. The market collects liquidity there and falls. At every low, the crowd sells in fear. The market collects liquidity there and goes up. And this pattern repeats again and again, in every time frame, in every market. Understanding liquidity means decoding the psychology of price.
Because price moves only when it gets fuel, and that fuel comes from retail traders. The market will always go to the place where most traders place stop losses because that's its food. Learn to see liquidity. The chart itself will show you the direction. In trading, there are two types of traders. One who chases the chart and the other who understands the reason behind the chart. The former gets trapped every time. The latter is prepared every time. The market rewards the prepared, not those who predict. So friends, remember that understanding liquidity means catching the breath of the market. Every time a candle moves, ask yourself, why is this candle moving? Whose stop loss was triggered? Who is selling in panic? Whose hope is breaking? And when you start seeing the answers to these questions, you won't be reading the chart, you'll be reading the mind of the market. But don't stop, because understanding liquidity was the first step. The real game has just begun. Now the next part will tell how the market hunts liquidity and traps traders in a psychological trap every time. Yes, friends, the next chapter is Stop Hunt Psychology, where traders lose and smart money wins. And believe me, when you hear that, your chart will never look the same again. So friends, think how many times has it happened that you saw a perfect setup, took an entry, and the candle hit your stop loss exactly, then ran in the same direction. That moment echoes in your mind. Why does this happen only to me? Is the market watching me? And that's where the stop hunt game begins. Stop hunt sounds like a very technical word, but in reality, it's very simple. Whenever the market moves in a direction, it first collects liquidity from the opposite side of that direction. Meaning, if the market has to go up, it will first go down to pick up the stop losses of sellers lying below and get fuel. And if the market has to go down, it will first go up to collect energy by picking up the stop losses of buyers. That is, the market never moves until it gets energy. And where does that energy come from? From the stop losses of retail traders. Every time you think the trend has started, the market thinks, now liquidity is ready. The market needs your order. Because your order is its profit. Your loss is its entry. Your panic is its power. And this is stop hunt psychology. The market's job is simple: to confuse the crowd, to excite the crowd, then to crush that excitement. Every breakout candle that seems like an entry signal to you is a liquidity signal for smart money. It sees where traders are excited and it moves in the opposite direction, because smart money always plays against the majority. Think, if every trader takes an entry at the same place, then in which direction will the market go? The market will always go where liquidity is left. The crowd is always predictable, and the market punishes the predictable. Every time the crowd thinks the trend has started, the market thinks now the hunt has started. Stop hunt is not a mistake. It is the market's structure. It is coded behavior in the system. Smart money does the same thing every time. First, it creates a trap, then it breaks the trap and starts the real move. That's why before every strong move, there is a false move. Before every rally, there is a sharp fall. Before every drop, there is a fake rise. And behind every fake rise, there is liquidity. To run the market, it doesn't just need buyers and sellers. It needs imbalance. That imbalance is created when someone becomes overconfident in the wrong direction. That is, when the crowd is overconfident, that's where smart money plans its entry. Now imagine you bought on a breakout. The chart looked clean, momentum was strong, everything was textbook perfect. But as soon as you entered, the candle fell back down. You said wrong breakout. The market said stop hunt. Because thousands of traders did the same thing as you, and everyone's stop loss was there, below the breakout candle. Smart money saw that liquidity had gathered here. It went there, took liquidity, and then started the real up move. Now you are out. The market is flying up, and you just keep looking at the screen. Inside every candle, there is a trap hidden. Behind every spike, there is a plan. Every fake move is collecting someone's liquidity. The market never comes to defeat you. It comes to test you. It wants to see if you will go with the crowd or think above the crowd. Stop hunt is a test of your patience, observation, and maturity. Every time you become impulsive, the market gives you a lesson. Every time you remain calm, the market rewards you. Winning in trading means recognizing the trap, not prediction. Stop hunt always happens where the crowd is most confident, because the crowd's confidence is its weakness. The market targets those who think it's confirmed now, because confirmation is the first step of the trap. Smart money watches patiently. It waits to see where the crowd is excited, and when everyone leans in one direction, it starts the opposite move. Now you must be thinking, does the market trap every time? No, the market doesn't trap every time. It only traps when the majority becomes predictable, because when everyone starts thinking the same way, the market gets energy to move. The real pain of a stop hunt is not that the money is gone. The real pain is that I was right, yet I lost. Because the market defeats you not with logic, but with emotion. It takes your confidence, turns it into overconfidence, and then defeats you with your own certainty. Smart money enters at your I'm sure moment and exits at your I was wrong moment. Every time your stop loss is hit. Don't get angry. Observe. See where the market took you out. Was there liquidity there? Was there a trap there too? If yes, then it wasn't a stop loss. It was smart money's entry zone. And when you start seeing this pattern, then you will understand that the market was not against you, but against your emotions. Understanding stop hunt means decoding crowd psychology. You need to see where people are overconfident, where people are in panic, where people are in revenge mode. Every emotion turns into liquidity, and liquidity is the breathing of the market. Every time the candle moves fast, that move is powered by liquidity. Every time the candle suddenly reverses, that reversal happens by collecting liquidity. That's why every smart trader sees emotions more than price. He reads the psychology of the candle, because the candle never lies. It always shows someone's weakness. Stop hunt is not just a market trick. It is a reflection of traders' minds. The market only defeats those who trade with only emotion without a plan. And smart money only wins over those who don't observe, who repeat themselves. Now, remember, every time you get caught in a trap, it's not your failure, it's your feedback. The market says, look, the crowd behaves like this. Will you behave the same way? If you observe and change, next time the trap won't be yours. Your profit will be. The biggest strength of Stop Hunt is this. It makes you humble. It teaches you that winning in trading is not about candles, but about your reactions. Every fake move tests you. Will you react or wait? And this difference makes a retail trader a smart money thinker. But friends, this was just the beginning. The market doesn't just take stop losses. It takes emotions too. Now, what's coming will show where smart money looks for liquidity and how those zones are formed from where big moves begin. Yes, friends, the next chapter will reveal the secret that every professional trader keeps hidden inside. Liquidity zones, the map for smart money. And when you hear that, you won't see lines on the chart. You'll see the footprints of smart money. So friends, sometimes looking at the chart, have you ever felt that the price touches the same level again and again, goes up a little, then comes down, and then, one day, boom, the whole market runs in that direction? You think, wow, this was planned beforehand. And that's true. Yes, it was planned, because that area was a liquidity zone. What is a liquidity zone? In simple terms, it's a place where traders' orders are filled, where the crowd is trapped, where smart money gets fuel to run its massive trades. The market needs liquidity, and liquidity is where people trust. Support, resistance, trend lines, breakouts. Smart money knows where the retail trader is thinking. It knows that everyone will buy from support and sell from resistance. So what does it do? It goes below support. It picks up liquidity there and then throws the candle up. Think for a moment. There's a support built on the chart. Every time the price bounces from there, retail traders say this is strong support. Now, everyone's eyes are there. Everyone plans to buy. And stop loss just below support.
Now, guess what smart money will do? It will go below support. It will collect stop losses, take liquidity, and then push the price up. Retail traders will say fake breakout. Smart money will say perfect entry. Liquidity zones are like maps on the chart. These are the places where the roots of future big moves lie. The market explores from where liquidity gathers. A liquidity zone is the market's fuel tank. First, fuel is collected, then the journey begins. If you learn to see where fuel is being collected, you will never be confused about where the price will go. Now understand one thing. Liquidity is of two types: buy-side liquidity above and sell-side liquidity below. There is liquidity at every high and low of the chart. Buyer stop loss above the high, seller stop loss below the low. Smart money first collects liquidity on both sides, then moves in its real direction. That's why the market often moves in a range. It is collecting fuel, and when the fuel is full, the market explodes. Liquidity zones are all those parts of the chart where traders are confident. The market always goes where traders are certain, because certainty means stop loss, and stop loss means liquidity. Every time a trader thinks, now it's confirmed, the market collects liquidity from there. And when the crowd gets trapped, smart money moves in its planned direction. Now think of a small story. There's a trader named Rahul. Every time he looks at the chart and thinks, this support is strong, it will bounce from here, he buys. The price goes up a little. Rahul is happy. Then suddenly the candle falls. Stop loss hit. Rahul is out. A few minutes later, the market goes up again. Rahul thinks, why me? But the truth is, the market didn't defeat Rahul. It was targeting Rahul's predictable entry, because thousands of traders like Rahul were thinking the same thing. All their stop losses were there, and that's what formed the liquidity zone. Liquidity zones are formed by the crowd's thinking. The bigger the crowd, the more liquidity, and where there's more liquidity, that's where smart money's attention is. Smart money doesn't read emotions, it reads patterns. It knows where retail will be confident. It waits, observes, and as soon as liquidity is ready, it moves. Have you ever noticed that the market often gives a sharp spike before news? Sometimes creates a fake high, then comes down, or creates a fake low and then shoots up. That spike is a liquidity hunt. That spike is the footprint of smart money. Retail traders think the news reversed the market, but in reality, the news is just an excuse. The move comes from liquidity. The market first collects liquidity, then it uses that news as a trigger. If you connect liquidity zones with candles, then every chart will tell you there's a crowd here, there's a trap here. Every time the candle repeatedly touches a level, that area is becoming a liquidity zone. That's smart money's waiting area. Like a lion hidden in the bushes, it will hunt when the crowd reaches there. The market does the same thing. It remains quiet until liquidity is ready, and when the crowd comes in, boom, it starts to move. For the market, liquidity is like oxygen. Without oxygen, it can't survive. That's why it will always go to places where traders are trapped, where stop losses are piled up. Liquidity zones are the places where price is manipulated. The market decides where the next trend will go. Now listen, every liquidity zone tells a story. It tells where the crowd had hope, where there was fear, where patience broke. The chart doesn't just show numbers, it's a map of emotions. Every line, every wick is a mark of someone's greed or panic, and smart money finds liquidity from these marks. The art of seeing liquidity zones teaches you calmness, because a smart trader doesn't look for entries, he looks for observation. When you see that the price is repeatedly testing a zone, then understand there's liquidity there. That zone will form the base of a future move. The market never breaks out randomly. It always breaks out from a liquidity zone. That's why before every breakout, there's accumulation. Before every fall, there's distribution. And both processes mean the same thing: liquidity collection. Now you probably understand why every time the price spikes above a level and comes back. It's not tricking you, it's recharging its energy. A liquidity zone is where the market breathes, where it rests, where it balances itself before the next explosion. In the market, the trader who identifies a liquidity zone can see the future. He knows that a move is coming. He doesn't enter, he waits. And when the crowd is trapped, he quietly takes his position. This is the difference between a trader and an operator. A trader reacts, an operator prepares. A trader gets scared looking at the candle. An operator smiles looking at the candle, because he knows this is where liquidity is being collected. Every candle points you towards a liquidity zone. You just have to learn to see it. Every retracement, every fake spike is a clue. Liquidity zones are the secret maps where smart money makes its way. But friends, a liquidity zone is not just a map. It's also a trap. Because the market doesn't just collect liquidity, it also induces traders, meaning it pulls them into a trap. Now the next chapter will show you how the market attracts you with fake moves, and how every time you prove yourself wrong even after thinking you were right. Yes, friends, now it's time for the next secret: inducement, the trap before the move. And when you hear that, your chart won't scare you. It will make you laugh. Because then you will understand that behind every trap, there's a master plan. So friends, have you ever noticed that when the price goes above a level, it pauses a little, then falls rapidly? Or when it goes below support, traders sell, and in a short while, the candle shoots up like a rocket. Every time you thought it was a fake breakout, but in reality, it wasn't fake. It was a planned trap. And that trap is called inducement. Inducement, in simple words, the market gives you an illusion that the move has started. You take an entry, become confident, and then the warm candle bursts in the opposite direction. Your stop loss flies away. You get angry, and the market starts the real move from there. You say the market is manipulated, but the truth is, the market is not manipulated. You are emotional.
Inducement is the market's oldest trick and the most beautiful too, because this trap is formed from your hopes. The market uses your mind against you. It knows what the retail trader wants to see. Breakout candle, momentum, confirmation, reversal pattern. It shows you exactly that, and as soon as you trust it, it turns you into liquidity. Behind every inducement move, there is only one objective. Smart money needs liquidity. And how will it get liquidity? When the crowd takes an entry. What does the crowd need to take an entry? An illusion that the trend is now confirmed, so the market creates that illusion. Now imagine there's a clean resistance on the chart. The price has been rejected there repeatedly. Now the candle finally breaks it. Retail traders shout, "Breakout, breakout, take entry." Everyone buys. But smart money knows the crowd is trapped here. It waits. A little later, the candle falls. Everyone's stop loss is triggered, and then the market starts the real move down. Retail trader angry. It was a manipulated move. But in reality, it was an inducement move. Why does the market need a fake breakout? Because it needs liquidity. Every breakout attracts traders. Traders get excited, they place orders, and that's where liquidity is formed. The market first collects that liquidity. Then the move explodes in the opposite direction. That's why before every strong trend, there is a trap move. The structure of every inducement is simple. First, the market goes above or below a known level. Second, the crowd takes an entry with confirmation. Third, the market moves a little to boost the crowd's confidence. Fourth, then it suddenly moves in the opposite direction. Fifth, the crowd exits, smart money enters. That is, your exit is its entry. Inducement is not just a candle trap. It is a psychological illusion. The market gives you confirmation because you want certainty. But in trading, certainty is an illusion. The market punishes certainty and rewards doubt. The trader who remains doubtful waits, observes. He watches who is getting trapped, and when the crowd gets trapped, he enters with a calm mind. Now think of a real example. You saw a higher high on the chart. The price went up. You thought the trend was bullish. You bought. But the candle came down sharply a little later. Your stop loss was hit. You were out. And then the candle didn't stop there. It went up like a rocket. You got angry. This market is playing a joke. But smart money was smiling because it took your stop loss. It collected that liquidity, and with that same energy, it threw the price up. That is, your stop loss became its entry point. Inducement always works against your trust. The market shows you what you want to see, and it shows it only until you believe. As soon as you are confirmed, the market moves against you. Have you ever noticed? Every time you say, "Now the move is confirmed," that's when a reversal happens, because that confirmation is your downfall. Smart money enters where the retail trader is overconfident. The market is a magician. It doesn't trick you, it changes your perception. It doesn't change the shapes of candles, it manipulates your conviction. Inducement is powerful because it seems logical to you. You think, "I'm following the strategy." But in reality, you have become part of smart money's game. Smart money never enters on noise. It waits for the crowd to get trapped. Inducement is that trap that looks sweet to the crowd. Because every inducement move is an invitation. Come, take entry. The market has now started moving. And as soon as you accept, the market throws you out. Every inducement zone is smart money's liquidity pool. The market first creates inducement. It attracts traders, it collects their orders, then the move explodes in the opposite direction. That is, every inducement is a launch pad. But for the crowd, it's a trap, and for institutions, it's fuel. Successful trading is for those who can identify inducement. You don't need to look at candles on the chart. You need to look at behavior. Where the crowd is excited, inducement is being formed. Where the crowd is fearful, liquidity is being collected. The market always works on extreme emotions, either fear or greed, and inducement is a mixture of both. Every inducement asks you a question. Can you wait? Can you think against the crowd? Can you choose observation instead of reaction? If yes, then you are moving with smart money. If no, then you have become liquidity. The market gives you a chance to choose every time, to stay with the crowd or to become an observer. Inducement tests your patience every time. Every time it sees if you can recognize the trap or will jump into it. The biggest edge in trading is not strategy. The edge is awareness. Awareness of, why is this move attracting me? Is this candle genuine or an inducement? Is this momentum or a liquidity grab? When you get into the habit of asking yourself these questions, then you will no longer be part of the crowd. Then you won't get caught in the trap. You will create the trap. Every inducement makes you humble. Every trap gives you a deep understanding. The market teaches you every time it drops you that every move has a reason, and that reason is not emotion but liquidity. But brother, this game doesn't end here. The market doesn't just create traps. It tests patience after the trap. Now what's coming is the most underrated power of trading: patience. The same skill that differentiates smart money from common traders. The same skill that is the master key to every liquidity move. Yes, friends, the next chapter is the power of patience in smart money trading. And when you hear that, you will understand that waiting for liquidity is a greater art than seeing liquidity. So friends, in this entire journey so far, we have seen a lot. What is liquidity? How does the market collect it? Where traps are formed? And how smart money defeats the crowd every time. But now we are at that door where every great trader looks different, because he has one thing: patience. Patience is a simple word, but the foundation of entire trading psychology. The silence between every candle is where patience is hidden. The pause that comes after every fake move is the sign of patience. The market is showing you something every moment, but it doesn't open up to you until you learn to wait. Every trader learns strategy. Every trader creates setups, but very few traders learn to wait. And this is why smart money becomes a trader, not an impatient trader. Look, the market creates traps every day. Every day it shows inducement. Every day something tempting appears to you. But smart money doesn't enter every day. It waits for liquidity to be ready, for the crowd to fall into the trap, for the price to gather energy. Because smart money knows that behind every big move in the market, timing is hidden, and timing is only found when you wait. Patience does not mean doing nothing. Patience means waiting for the right thing. The market will provoke you with every candle. Enter now, the move has started now. But a smart trader will smile because he knows that before every big move, the crowd is excited. And the excitement of the crowd is liquidity. That's why he remains calm. He observes. He doesn't look for entries, he looks for the trap of confirmation. In trading, patience teaches you three things: silence, clarity, control. When you are silent, you can hear the chart. When you are clear, you can see the trap. And when you are in control, you flow with the market, not against it.